Hello, everyone. Joe Mass here. It's June 20th, 2022. I just want to walk through some Synergy snips and review what happened last week. So over the weekend, most of you are aware that equities plunged last week, basically on hot inflation, right? We've been talking about what drives the market: interest rates, inflation, corporate earnings, the Fed, and right now, front and center is inflation, and the markets definitely pulled back on the threat of continuing to see prices rise. So on this chart, let's start at the bottom on that orange line there. There is your CPI. That's your consumer price index numbers year over year. It came in at 8.6%. If you look at the middle panel there, the purple line, that is the University of Michigan's expected inflation over the next 1 year at 5.3. And then, of course, the top panel is something that we've been showing you frequently for many years, and that is the PCE annual inflation rate in the orange line at 6.3. The 3.0 line, the white line, is the University of Michigan's 5-year to 10-year inflation outlook, and the red is kind of where the Fed has targeted inflation. So definitely we see inflation high, and the markets have been reacting accordingly. This breadth in the market, there's a lot of breadth, there's a lot of participation going in the wrong direction, right? So it's really brought on the bears. The blue lines, or the blue bars, are the percent of our universe that are larger than 10% off their high. So currently 98% of the stocks are off 10%. And the red bars and the red line is the 20% off the high. So currently about 78% of this universe, which is predominantly the S&P 500 here, is in a bear market, okay? So bears turn to bulls eventually, right? We hope. So here's looking at the same chart with the S&P 500 overlaid on top. And you can see that when there's big dips in the market, right, that's when we're in a bear market, and you'll see those red bars hitting 20%. And the majority of the stocks are in a bear market. Remember that the tide floats all boats, right? So that beta effect drives the market. When you see those red bars coming down, you start to see the market take off, right? So we are definitely at having broad participation with equities on that bear market side. Another way to think about it is, here we're looking at the New York Stock Exchange's 1,500 stocks that are above their 200-day moving average. And you're going to see that right now it's only about 14.76% of the stocks are above their 200-day moving average. And so it's a very bearish signal, right, which confirms the data that we saw in the prior chart. But here you're going to notice that bottom red line at 1931, that is the second standard deviation. So how you read these lines on this chart is this green line in the middle. That is, this is your average, going up 1 standard deviation point and then going up 2 standard deviation points. So the downside, this is the downside, the first deviation, and then the second standard deviation. So what you'll notice is that when we've broken below the second standard deviation, you can see that it can stay down there for a while, but eventually it broke up past that average and even went up to the above to the first standard deviation. All right, down here again we see it staying down. It tested it, came back down, but that got back to average. Here we got back to average. Here we got back to average. So there's hope down here that so many things are in that bear market territory that the bottom, could be getting close. Now, nobody knows, and I think there's probably a little bit of downside left in it, because as you can see from these prior periods that this can stay below that line for quite some time before it rebounds, right? So we don't know when that's going to happen, but there is a little bit of hope that we might see a bounce here sometime before the end of the year, right? So anyway, we just wanted to share this data with you. And again, most of you know what's going on, but we want to just give you some talking points that you can share. What are we going to do? What's our course of action with this data? What does all this mean? It means that we're going to continue to manage each portfolio per its design. We have portfolios that are built for those risk-on investors who want to fight inflation. We have risk off portfolios for those investors who want to fight the geopolitical risks, right? We've talked about that in the past. We're suggesting a diversified portfolio via broad asset allocation, right? Really trying to find that hedge. Now, some of the clients out there, you might want to be all risk on and really be tilting towards equities. The other side of the coin is this might be a great time to buy equities because they are down so low. And then on the other side of the coin, you might be really wanting to fight that geopolitical risk with bonds and cash and treasuries and things like that. We'll continue to manage all of these portfolios so that you can maintain your broad diversification. And then again, we're just going to watch the data and try to recalibrate the portfolios as best as possible as that data comes in. There you go, just a quick update from last week. We really thank you for your trust. Of course, anytime you have any questions, just give us a call and we'll be happy to answer your questions. Until next week, thank you very much. Bye-bye.